Okay, let's look at the first type of um option spread trade, and the prime trade select has produced a lot of winning trades. So what we want to do is, of course, if we have a winning trade, we want to buy a put option to help protect those profits. And so if we use our option directional trade selection and we have a profit in that call option, then at a later date we want to buy a put option, create a spread, and this helps lock in the profits of our trade, and sometimes it can even guarantee a profit. So if we create these spread trades, you could have a severe sell-off in the market and you'll still profit on your trade. So we call these market neutral spreads because the call option, of course, profits as the underlying stock moves up in price. The put option profits as the underlying stock moves down in price. So we call these market neutral trades, and we'll look at some examples of market neutral spreads. And here's one for Cigna, and you can see we in our brokerage account we bought the Cigna September 70 call, and we paid 188.5 for that. So we bought we used Prime Trade Select to select this 70 strike call. We paid 188.5, which is $188.50. So we bought the Cigna 70 strike call at 188. Cigna went up in price. The underlying stock went up in price. It only had to go up 1%, and we're going to break even. It went up a lot more than that. So we wanted to protect those profits. So what we did is we bought an at-the-money 77.5 strike put. So again, bought the 70 strike call at 188 and bought the 77.5 strike put at 161. So once we bought that put, that created an option, a market neutral option spread trade for Cigna, and we'll take a look at the risk profile for that. And we actually have a calculator for market neutral trades, and we can see again we bought the Cigna stock at the time was trading at 77.72. We bought the 70 strike call at 188, the 77.5 strike put at 161, and this will calculate the profit potential assuming various price changes in Cigna stock at option expiration. In this example, from a 20% increase to a 100% decrease, and we can see if Cigna stock was flat at 77.72, we'd realize a $422 profit on the spread, 120% return. And by buying that put, it doesn't limit the profit potential. So if the stock goes up 10%, we have a 342% return. If it goes up 20%, we have a 564% return. But also, if the stock were to go down substantially, let's say it dropped 20%, the spread would produce a $1,182 profit, 337% return. And we wouldn't anticipate that it would drop this much, but we just put that in there just to illustrate that even if it dropped 100% to zero, we'd realize a $7,400 profit on the spread. So these market neutral spreads can profit if the stock's flat, and that would be the minimum return, by the way. It would be the 120%. If the stock starts declining, our profit potential increases. If the stock starts increasing, our profit potential increases. So this is a great way to trade options, and once you put these trades on, you can just forget about them until expiration. You don't have to monitor the markets because you've already locked in a guaranteed profit on your trade. So it's a great way to trade options. Let's look at one more example. This is the Home Depot, and we use Prime Trade Select to buy the Home Depot 80 strike call. We paid $10.15. We got a low risk entry. The stock went up in price, so we had a profit. And then we bought the at the money put, the 110 strike put at 420. So we bought to open 45 of the 110 puts at 420, and let's look at the risk profile for this spread. Home Depot was trading at 115.17, bought the 80 strike call at 10.15, 110 strike put at 420. If the stock was flat at option expiration, we realized 145% return, $2,082 dollar profit on the spread. And if the stock goes up in price, then our potential on the spread keeps increasing from 225% for 10% increase to 305% return for 20% increase. And then, of course, if the stock goes down, we still profit. So in this example, we're locking in by buying that 110 strike put. We're locking in 145% return for the spread, or $2,082 profit for the spread. So here's one more example. We don't have time to go through this one. This is for XLV, but you can see that these market neutral spreads, it allows you to, if you have a profit on your directional call option trade, you can actually guarantee a profit by buying a put option. And there's one more option spread strategy I can talk about here, and it's option debit spreads. We don't trade the credit spreads, we trade the debit spreads, and we follow our money management rules. If we have a profit in a directional call option trade, then we can sell a call option with a higher strike price to create a debit spread. And if you purchase a call option, you have a profit, and you leg in at a later date by selling a call option. When you sell that call option, you increase the profit potential of the existing option purchase, and you also provide downside protection in the event the underlying stock decreases in price. And of course, the call option that you purchase will profit if the price of the stock increases, and the call option that you sold will profit if the price of the stock decreases. Your risk is limited to the cost of the spread. Here's an example for XLU. We bought the September 42 strike call. We paid $4.74. So bought the 42 strike call, $4.74. We had a profit in this trade. XLU moved up in price. We used the 1% rule to select this strike price, and we had a profit in this trade. So at a later date, we sold the 48 strike call. So bought the 42 strike call, $4.74, had a profit. So we sold the 48 strike call at $190, and when we sold that at $190, then $370 in cash income went into our account. And the selling the 48 strike call at $190 actually increased the profit potential of our 42 strike call purchase. And the sale of 48 strike call also provided downside protection if XLU declines in price. And we have a call option spread calculator for debit spreads. And again, you saw from the brokerage statements, we bought the 42 strike call at $4.74, sold the 48 strike call at $190. At the time, XLU was trading at $50.32. So let's look at the risk profile for this trade. If the stock was flat at $50.32 at option expiration, in this example, we'd realize 111% return for the spread and $316 profit. So the cost of this spread by buying the 42 strike call at $4.74, selling the 48 at $190, the actual cost for this spread was $284. So if the stock is flat, we have 111% return. If the stock goes up at all, we would have 111% return, $316 profit on a $284 cost. And if the stock goes down, we can still profit. If it goes down 5%, we'll still have 104% return. If it goes down 7.5% at expiration, we'll have a 60% return.